Hello and welcome to the latest edition of our Wescott Investment Webinar Series. I'm Mark McCarron, Wescott's Chief Investment Officer. In today's edition, we'll be providing our thoughts on the recent market performance, but we'll also look at some of the specific portfolio actions that many of our underlying managers took over the course of the first quarter to better position portfolios for the future. And finally, we will provide our latest outlook for the economy. So let's just bring everyone up to speed as to what's happening. The sudden slowdown in global economic activity is starting to show up in the official numbers. For example, we just got the note from the economic growth. The first quarter GDP declined by about 5% from a quarter earlier, and it's expected to fall further in the second quarter of this year. Importantly, to combat the dramatic slowdown, the U.S. has committed massive stimulus on the order of nearly 12% of GDP, according to research by bank credit analysts. And this is taken the form of loans, unemployment benefits, and direct payments. And that's really been helpful for the global economy, for the U.S. economy, and particularly the markets. While those filing for unemployment benefits remain in the millions, the pace is slowing, which suggests that the worst may be behind us. While concerns for the current economic environment remain, what we see from the University of Michigan survey of consumers in April is that while consumers had a very negative view of the current situation, there is a little bit of a better and higher expectations for the year ahead, which does highlight the cyclical nature of the coronavirus. So what we're looking at here is the University of Michigan Consumer Sentiment Survey, dropping from well over 100 in February of 2020 down to 72, 73, which is a pretty significant drop, in fact, the largest drop in history. However, markets tend to be forward-looking. And while the consumer sentiment numbers were negative, the fact is that the markets and investors are looking beyond the current numbers and looking and pricing in expectations for improved economic conditions as more and more states open up their economy. And that can really be seen in the market update. So let's take a look at the markets. We've seen quite a rebound in the US stock market in April and May, despite the fact that the US economy contracted by 5% in the first quarter and consumer sentiment remains at record lows. In fact, the S&P 500 index is up 17.6% quarter to date and has cut its losses for the year to only minus 5%. And that's as of May 27th. The S&P 500 Equal Weight Index, which is an index we introduced in a previous webinar, has also performed well since its March lows. Its return of 20% so far this quarter does suggest that the recovery is more broad-based than just the largest stocks in the index. And importantly, we'd like to highlight that the fact that a broader market, such as the one we're seeing in the second quarter, does provide more opportunity for active management to add value. And that's really the focus of our conversation today. While much of the attention in the media has been placed on the largest stocks in the market, Amazon, Microsoft, Alphabet, our managers are finding opportunities at large companies that are well run, but at a level below the so-called FANG stocks. So we have a few examples here that we'd like to walk through. And the first is our large cap growth manager, William Blair. And they focus on identifying what they call structurally advantaged companies, or those that they believe will be better off in 3 to 5 years than they are today. One example that the team recently added to during the quarter is Activision Blizzard, an industry leader in the video game industry. The stock experienced strong performance of Call of Duty and World of Warcraft games, which are very popular, and benefited from the company's new video games offered during this period of shelter in place. And this increased video game engagement resulted in accelerated consumer adoption of the company's new releases. So the team at William Blair increased their positioning in the stock as they are encouraged by the company's long-term growth potential in a growing industry. Another example we'd like to highlight is Live Nation, which is a global leader in live entertainment, concert promotion, and venue operations. Clearly, the stock has experienced the impact of social distancing measures, given the fact that live events and large crowds are no longer occurring. The team believes, though, that the stock is uniquely positioned to improve its already dominant position within the concert segment once this period of time and the social distancing have been lifted and we return to a more normal environment. And the final thing I'd like to highlight for William Blair is that Amazon.com, which is up 30% so far this year, they've taken the opportunity to reduce their position there, really on strength. So what we're showing here is performance year to date for each one of these stock examples. And these are actions taken by the managers in the first quarter. So let's talk a little bit about Royce Opportunity, which focuses on an altogether different part of the US stock market. In fact, smaller companies, more value-oriented, more contrarian, in fact. So Royce Opportunity is a deep value style investing, and they tend to invest in distressed areas of the market. And they typically look for companies that they can invest in, which are trading at steep discounts to what they believe the companies are worth. So during the quarter, the team added consumer names such as Dunkin' Brands and also home builder Toll Brothers. So let's focus on the home building. While the U.S. housing market did suffer a setback in the early part of this year, there are expectations for a recovery, and that supported the stock performance so far in the second quarter. Then the final manager we'd like to highlight in the area of the market that we'd like to highlight is the emerging markets. Within, Wescott's emerging markets manager, Morgan Stanley, has added to their current position in the technology company Samsung, as the stock has held up well during the recent drawdown. They've also added a new position in Kakao, which operates Korea's largest mobile messaging application. And this company has spent the last few years expanding their business into new areas such as mobility, payments, and content. It just highlights that there are great opportunities not only in the US, but outside the US, with Kakao so far up 69% year to date. The one area that we'd like to focus on finally with Morgan Stanley is an area in the stock that they're actually redeeming from or selling out of. They sold their position. They're generally reducing their exposure to banks, but they sold their position in Commercial International Bank, which is an Egyptian private sector bank. And it's kind of a little far off and far afield, but this bank benefits from global trade because they get quite a lot of the revenue from activities going through the Suez Canal. And clearly, as global trade slows and perhaps doesn't recover fully, the team at Morgan Stanley felt that this was the right time to sell out of that position. So I hope you can see through these examples that there are opportunities below the surface, below the largest companies out there, where active management can make a difference. And in that context, looking forward, we believe that a full return to economic growth is largely dependent on the development of the COVID-19 vaccine, which we've seen some positive news, although very early stages. In the short term, we think the economic recovery will be uneven, but this provides opportunities for active management, as we've talked about in today's conversation. And finally, we maintain our expectation for a U-shaped recovery as states begin to open and consumer spending starts to pick up again. As always, thank you for joining us and for your trust. Please do not hesitate to reach out to me or your advisor with any questions you may have. Thank you.